The topic I chose was tools for financial statement analysis. I think it's important to understand how to properly read and analyze financial statements, whether you're running a company, whether you're a board member for a company, or even just investing in a company. When analyzing specific tools for financial statement analysis, we must recognize what tools are available to use and what purpose these specific tools serve. First, we must consider financial statement analysis from the perspective of both accounting and corporate finance. Since investors and creditors make their investment and or lending decisions based on the financial statement of a company, it is vitally important to keep a great track record of at least 3 to 5 years of business when compared to competitors and the industry overall. The three tools are horizontal analysis, vertical analysis, and ratio analysis. Now, with horizontal analysis, it's comparing the performance of the business year to year. And that can be used to track current trends, can even track projections inside of a company, but it's set up from an outside perspective. Vertical analysis, that is used to compare performance with a competing company, which can be valuable to understand where a particular market is growing, decreasing, or stagnant, and how a company accurately matches up to the demand of the market. Last is ratio analysis, and that compares a corporate entity's performance with the industry in and of itself. So that can be used to determine any of those unicorn companies that change industries. Companies, if you can imagine, like Airbnb, Uber, or even Amazon. All of these can be integrated into corporate financial reports. And those reports are where the SEC requires publicly traded companies to file quarterly and annually reports, starting with the overview of their business, the overview of the industry in general, what are their growth strategies, and a description of all of the brands and products under that umbrella. So if you're an entry-level professional, you may work in auditing and report on the fairness and accuracy of these financial statements. You could be the person who's filing that away for your CEO. A mid-level professional would work alongside the management discussion and analysis team, or MD&A as it's called, and be responsible for helping investors and creditors understand the financial health of the business and the results of the operations. Now, if you're an executive level professional, you would be responsible for the significant accounting policies used, and you would need to explain those specific items on the financial statements that get sent out to investors and creditors. You want to make sure that aligns so that you're not in trouble. In my opinion, the largest ethical dilemma that can get you in trouble and can stem is from the discernment of a healthy company's bottom line. So if a company were to prepare solely horizontal analysis reports and seem to be doing very well, quote unquote, on paper, but was grossly behind the industry average for production or sales, it can highly mislead investors and creditors to lend more funding to this company, which could surely fail. So to fix this, I would employ a quality assessment firm to ensure that the benchmark of the industry do match up with the production of the company, and make sure that our numbers align so that it transparently describes the real value of the company. Now, in utilizing that in your business, the question then becomes, how can you use this today, and how can you use this to influence your company moving forward? So when you look at these tools for financial analysis, understand that this is just the beginning. Without a statement of cash flow, it's very hard to even look at a financial statement analysis because you don't know what you're analyzing. So at the same token, it's very, very important to understand money in versus money out. Very, very crucial to get a good understanding of what are your accounts payable and what are your accounts receivables. Things that are driving your business growth while minimizing the expenses that are actually being paid out for either human capital, regular labor, whether that's technology, whatever it may be, production costs. All of those things must be equated and balanced out so that you have a clear, transparent view of the business, of your company, and of the industry. If you lack the ability to do that in your business, you will end up finding that your business will soon fall under. And I say that in the very real sense of companies that we've seen over the past 20 years. If you think about Enron, you think about Stratton Oakmont with Jordan Belfort. These companies on paper, if you look at their horizontal analysis, or even if you look at their price to book ratio, very, very high, look like very promising companies. But those companies, when compared to the benchmark of the industry, did not meet the standard. And most of them were already broke long before it came out that some of them were scams or some of them were misappropriating their money in a very illogical and gross manner. So when you look out for that and you are transparent to the marketplace, you're building trust with your customers. And from that trust that you're building, all from the start of just a financial statement analysis will give you more credibility, will give you more options and more opportunities for you to actually use this funding that you get from investors, from creditors, and grow your business in a way that not only benefits your company, but benefits everyone overall.